Good evening, everyone. Thank you for joining this webinar where we'll be doing the passive market review along with we'll be also talking about gold and silver and international markets as well. So let's wait for 1 minute before we start the webinar so that more people can join. And what I'll do is I'll basically keep my monologue short so that we can take more and more questions about products, be it be gold and silver, or equity, or international, and I'll be uh, happy to answer as many queries as possible. So please post your questions in the comment in the chat box, and I'll take it up one after the other. So this is a monthly series which we do on a regular basis, where we sorts of review what is happening in the market. Our focus typically is more on how various indices are performing, uh, and we also dwell upon commodities as well as international markets. So if you are not attending this webinar regularly, please do so so that you are always aware about what is happening in the passive market as well as especially what is happening and impacting mirror asset passive products. So let's start with domestic indices first, and I'll go one by one. Basically, we know that in past 1 week's market has been turbulent. We saw sharp correction few days back, and then some recovery in the market. Market is again above 26,000 levels. If I'm talking about Nifty, so talking about Nifty first, been pretty flattish in last 1 month. If you're looking on a YTD basis, it's up 11%. Uh, but more importantly, it is uh, now around its all-time high. So if you look at the column where it is written percentage change high 3 years, so if I'm comparing its recent high, it is now just 80 basis point or 0.8% below its all-time high. So we had a very turbulent year. Now that we are uh, ending this year, at least markets seem to have recovered. But having said that, yes, last uh, 1 year returns have been pretty flattish, and in fact, and since the markets achieved its all-time high in Q3 last year, the market returns have actually been negative if you compare it from the all-time high. But the good thing is that markets recovered from where they were in March, April this year, which gets highlighted in the last colored column, which says that from the lows of 15-month market, Nifty 50 is up 17.8%. So that is what I think tactical allocation or at type timing the market also help, and we saw that a lot of people were using Nifty 50 ETFs to enter the markets where markets were at at bottom in last 15 months. So while it's still below its all-time high, down by 0.8%. On a YTD basis, it is up 11% on. But if you are comparing from its lows, it's up by almost 18%. Uh, Same stories with Sensex, so I won't dwell time on that. Nifty Next 50 has been negative in last 1 month and pretty flat in last 3 month as well as YTD, right? It's just 1.22%, and significantly different performance in two large cap indices. While Nifty has recovered, Next 50 is still lagging. Next 50 is dominated by your lot of PSU companies, lot of new age names also. So its portfolio is pretty different in spite of being a large cap index, pretty different from Nifty 50 in terms of composition, in terms of sectoral representation, and if I may say, the quality of stocks also, or the sturdiness of stocks also. So Nifty Next 50, which captures 51 till 100th rank stock, is still down 12.2% from its uh, recent highs, right? Which was touched, I guess, last year itself. So still high, but it has also recovered 20% or so from its 15-month low, which means that it has fallen a lot. While it has recovered, it is still 12% down. So, in fact, two indices which is Next 50 and small cap. So I'll talk about it later, but mid cap first. Mid cap again was negative last 1 month. This is December 11th ending data. 3 month pretty flattish. YTD up by 4.38%. It is around its all-time high, just 1.7% down, so not significant. And it has also recovered almost 24% from its 15-month low. But look at what is happening in the small cap side. Small cap is negative 1 month, 3 month YTD. 1 year it's negative 11.4%. It is still down 12% from its highs which it reached last year. While it has moved up by 19% from its 15-month low, it is still not recovered completely, down still 12%. So two indices on the broad market side which has done fairly poorly in last year or so is small cap and Next 50. When we look at Nifty 500, I think it's accumulation of everything. So its YTD performance is 6.51%, which is roughly around AUM weighted average of where the indices are, underlying indices are. It is down 3.3% from its 3 year high. It had also recovered 19% or so from its 15-month low. So whosoever invested at the market dips in these broad market indices, data shows that they would have earned between 15 to 20% in last 8 9 month itself, which is good, right, for anyone who has taken opportunity of market fall. When it comes to sectoral indices, again I'll go one by one. Financial services YTD phenomenal, 18.33, bank 17.67, PSU Bank 29.41, and Private Bank 15.7%. So at the start of the year, we had given a call on BFSI sector looking good, appealing from an investment point of view. Looks like it has turned out to be one of the best performing segments this year, especially the PSU Bank. PSU Bank is up almost 30% on a YTD basis, right? So 18%, 18.3% financial services, and out of which PSU has outperformed the most at around 30%, whereas private bank has been relatively laggard, right? Giving a return of 15.7% when its PSU counterpart is up almost 29.4%. Having said that, all of them are still below their all-time highs, or rather last 3 year highs. PSU Bank is down below almost by 4% or so. But just look at how significantly it has moved up from its 15 months low, almost up by 46%. So PSU Bank is the story of this year till now, giving stupendous returns, and last 3 months have been very, very good for PSU Bank with giving almost 16.4% return. So that is one product of ours which has done well, and our call also has gone okay there. But then we come to energy. Energy ETF we have launched just I think a month back or so. It is pretty flattish, 1% return, and it's down almost 22% from its 3 year high. So a good contra call product as of now, or rather not contra call, but a segment where you can take a call based on relatively lower valuation. Still 22% down from its 3 year high. And 1 year return is also pretty muted. Completely different story when we look at commodities. Commodities up 14.3%. So we also saw significant interest in our metal ETF, right? So within commodities, metals have done phenomenally well, right? And we'll come to that, but commodities have given almost 14.3% return, uh, up by almost 21.7% from its 15 months low. Then we look at utilities and power, which have not fared well. So utilities power continue to be on the something which is continue to be under pressure. So you have YTD performance of almost down by 5 and 6% from its 3-year high. And when I'm saying 3-year high, I actually mean high which was achieved last year. Typically, in when we pull data from Bloomberg, it's 52 weeks typically, but 52 weeks last 52 weeks has crossed the September high, so that's why I've taken the data for last 3 years. So most of the highs were attained 24 to in 2024. So please consider that when I'm usually referring to the highs. So utility and power is down 25.7% and 25.9% respectively from its recent highs, which is continue to be significant. The segment continue to be under pressure. Completely different is metals, right? When I was referring to commodities, just look at metals. YTD is almost up 20.6%. A lot of that is we are seeing because of China factor also, even in last 3 months, up by 5%, right? It's if we compare it from 3-year high, it's just down 2.3%, and in last 15 months from its lows, it is up by almost 34.2%. Manufacturing, because of metals being component of manufacturing, among other things like auto, it is now showing a return of almost 10.2%. In on a YTD basis. Now moving on, capital goods continues to be under pressure. YTD performance is negative. It's down 11.8% from its recent highs. Healthcare also continues to be under pressure. YTD is 2.25. Obviously, geopolitical issues and tariff uh, also comes into picture here. When we come to India consumption, it's 7.98% positive. So that was one particular segment which was battered first when earnings started dipping in Q3 of last year, if you all remember. So good to see that consumption is at least positive. FMCG though continues to be negative, 1.96% on a YTD basis. 1 month, 3 month have also been bad, and so is consumer durables. Autos uh, has in a way recovered. It was battered a lot, and on a YTD basis, we can see that auto is up almost 22.5%. Last 3 months, up by 3.45%. Media and reality continues to be negative on the YTD basis, as well as significantly down from its all-time high. Infrastructure, interestingly, is positive on a YTD basis, almost 12.8% return. Then, if you're thinking about this, then infrastructure में आपके you also get play of cements, commodities, etc. So it's a broader theme, and it's positive by 12.79%. PSU, BSE PSU is up by 7.4%. Alpha, as we expected, is continues to be down, right? On a YTD basis, down by 4.58% from its 3-year high. It is down by 15%. That is where momentum suffers when there's no trend in the market, and markets are basically evolving and changing, like we have been talking about it multiple times. But look at low wall. Low wall is up 10.67% on a YTD basis. Why I am especially mentioning low wall? Because low wall consists of your more sturdy stocks. So you look at typically it will consist of private banks, top two private banks, Reliance. It will consist of FMCG companies, etc., which you associate with low volatility. Now, these segments, especially FMCG, were the ones which were battered in Q4 last calendar year, and then people obviously got skeptical whether low vol works during choppy markets. Once that phase passed, when only FMCGs were impacted because of poor earnings coming out of even urban areas, when that phase passed, we see that at least low vol as a product stabilized, so giving a return of almost 10.67% on a YTD basis. So very quick summary. We see that Nifty is now close to its all-time high, just down 0.8% from its all-time high. YTD performance around 11%. Even mid-cap has somewhat recovered. YTD is down only up by 4.38%. Also from its all-time high, just down by 2%. But two broad segments which have not uh, recovered per se is next 50, like I mentioned, is down 12% from its recent highs, and small cap, which is also down 12% or so from its recent highs. So those two segments continue to suffer. If we look at entire year performance, since we are doing this in December, just wanted to highlight how well financial services and financial segments have done. PSU Bank has done significantly well, right? Almost 30% YTD performance, which is great. Has left private bank relatively far behind, right? 15% versus 30%, almost double the performance, which is significant. Then power utilities has not done well, negative single digit performance on a YTD basis. Energy has been flattish. We have recently launched product on that. Seems like a reasonable call when it is down 22% from its all time high. Commodities have done well, driven by metal, which is up by almost 21% on a YTD basis. Autos also moving up by 22% has helped. Metal and auto has helped drive the manufacturing index also to be up by 10% on a YTD basis. In terms of segments which are down significantly from its recent all-time high, it's energy, it's power, uh, utilities, even reality and media. But like I mentioned, that we have recently launched energy. It also represents power and utilities. So through that single product, if you want to play that uh, game where you are investing at deep corrections, energy is one segment where which you can look at. All in all, markets continue to be obviously trading at higher valuations. Even next 50, while it looks at, while it seems that Nifty next 50 is at lower valuation of, let's say, around 21.8, which is lower than 3, 5, and 10 year. But don't be confused, because now Nifty next 50 consists of a lot of PSU companies, because of which PE is down right now, looks down right now, whereas earlier it was not that PSU heavy. So while from data it looks it is less valued, in reality, if you compare apple with apples, it is not the case. From a valuation point of view, financial services interestingly still looks attractive when we are just looking at the data. So that was on how domestic markets have done across segments uh, sectors, themes, etc. Now let's very quickly look at international markets as well, because a lot of people who attend these webinars are people who have invested in our FANG, Hang Seng Tech, etc. We wish those products were open for subscription. They have been doing phenomenally well, and we really feel bad about the fact that these funds continue to be closed for fresh subscription, and they continue to trade at higher premium. But it is what it is. Looking at FANG, continues to do phenomenally, right? This AI story and the story around AI infrastructure, that is in such a such a momentum that it is just pulling everything with it, right? A FANG on a YTD basis is up 26%. 3-year return is on a CAGR 50.87%. If I'm just looking at 15-month bottom point, right now index is up by almost 60%. And from its all-time recent high, it is just down by almost 4%. So, continues to be a very, very strong story. And I believe that yes, there are concern around valuations at 39 PE. Uh, uh, you are you have to be concerned about whether this entire AI euphoria is going to be justified in terms of revenue and profits, and a lot of that is left to be seen. But I personally believe that this is not a bubble. Valuations can be a concern, so you may see some corrections if companies do not justify these valuations at next round of earnings. But the fact is that in last few quarters, earnings expectations have been met more often than not, right? For example, last quarter, Google came out with phenomenal numbers. So now Google is something which is driving the conversations around AI. Earlier, it was ChatGPT and Microsoft. So we are seeing the entire space evolving. The conversation is no longer restricted to NVIDIA GPUs. It is also about Google's TPUs, etc. So I think, yes, we have to be cautious about higher valuations, but I believe that from a long term point of view, obviously, this story and then what US Tech is doing, with what FANG companies are doing, is something which is obviously changing the way industries, economies, and people are going to function. Same it goes for AI and tech, which fund which we have done phenomenally well. 1 year return is almost 30%. 15 months it is up 63%. It is a more diversified version. Again, this is closed, but people who have already invested must be seeing good returns in our AI fund of fund. Nasdaq, like I mentioned, is a lot of that performance is driven by FANG companies itself. The contribution of Nvidia, Google, etc., has been phenomenal in driving the overall return journey of US. Uh, Same goes for S&P 500 top 50. Our top 50 ETF is a bit more diversified. It consists of top 50 companies with tech plus uh, other segments as well. 17% upside in last 1 year. Then we look at Hang Seng Tech, 23% upside. It has corrected also because of concerns around US China geopolitical issues, and the fact that we are still seeing significant deflationary pressure in China, and domestic consumption in China and property market continues to struggle. So I'll talk about US and China in bit more detail, but just wanted to show how the numbers are looking at. So Hang Seng Tech is up by 23% in last 1 year, and MSCI China Index is up by almost 30%. From valuation point of view, like I mentioned, that FANG continues to look expensive, uh, but the earnings continue to justify the valuation. That is the more important part. When you look at China, I think valuation continues to look still bit appealing, right? While that valuation gap has gone, but it continues to look bit more appealing. Now, I think more important is gold and silver, right? The amount of traction and questions and euphoria we are getting on gold, and earlier gold and now silver is phenomenal, right? Gold now is 1,30,000, silver is 1,92,000. When we are talking about offshore markets, it's almost $4,300. Silver is at $64. We are looking at silver giving a return of 23%. 45% last 1 month, 50% in last 3 months, and 124% on a YTD basis. It's absolutely a sorts of unhinged move, right? Because while we expected silver to do well, and that's what we have been communicating the way, but the way it is moving, uh, I would say that it has run up too fast too soon, right? While it continues to remain in deficit from a supply point of view, but the stories regarding its usage, etc., have been there since last 10 years. And from a consumption point of view, there is no very significant rise or news which has propelled it to 124%. But yeah, the people, when they are moving away from equity, investing in gold, etc., and then finding comfort in silver, and the fact that silver continues to be in deficit, the fact that silver hadn't moved uh, much for quite a long time before, but this last 1 year performance has been phenomenal, right? The question is how much this will continue, because 3 months back we gave a call of 60 to $65 for silver. It has already reached 64. uh, so while we continue to remain uh, optimistic on both gold and silver, uh, I think we need to mellow down our expectations. I think that silver has more upside, but its now drawdown risk is also higher. So you need to, if you're entering into silver now, you need to have a more sorts of cautious outlook on how long this rally will last and when there will be some correction. So be a bit cautious. I think do a diversified allocation. Don't do excess allocation in silver. Don't try to chase the returns now when silver is at 64. So we, while we, like I said, that we remain constructive on both gold and silver, I think both gold and silver has some room to go up a bit more, but I expect silver to be a bit more volatile. So be cautious about that. Uh, don't go ahead with excess allocation in silver. When we are managing gold and silver, what we are managing right now, our allocation is roughly around 52 48, 52% in gold and 48% in silver. That is what our rough allocation is. If silver corrects a bit and we see some pricing opportunity, I think we will increase the allocation in our silver product as well. So that is on international and silver. Why Indian markets continue to sorts of be choppy? I think personally I feel that obviously US India US trade deal will be a sort of a good confidence boost to the economy. Uh, I, I continue to believe that it's the earnings which will provide next leg of market run up in India. So what I've done is I've plotted multiple quarters in the graph, and I've showed the Nifty earnings on how sorts of it is projected. So what do I mean by that? That if you're looking at blue line, which is 25 Q3, which is September ending quarter, all throughout the earnings which is mentioned here, the earnings went down, right? Which means that expectation of earnings went down, and actually the earnings we ended up realizing in Q3 of 2025 was actually down from earlier projection, right? And downward trajectory suggests that we are continuing to see earning revision, which is reducing the expected earnings, which is not sorts of a good sign. So that is what we see for Q3 and in ending up here. Then we are seeing for 25 Q4, which is an orange line, and we see why it has gone down. You can see it has now in a way started to stabilize, right? So we are seeing that for 25 Q4, we are seeing that for next year first quarter, seeing that for quarter after that. So after a long while, we are seeing some uh, sorts of stability in terms of projected earnings, right? The cuts are not are basically less sharper or not happening, which is at least a good sign that okay, at least earnings are not being revised downwards and sorts of stabilizing in terms of projection. I think if we see a positive surprise in earnings for December quarter end or for March quarter end, I think that will be a good sorts of signal and confidence boost to the market. Similarly, if we are looking at FPIs, right, the entire conversation about INR being around 90, FPI is not liking the fact that INR is weaker, makes their return less, right? And we are seeing that in December there has been a negative flow, which is outflow of almost 16,000 crores, and in last 6 months, this is around 81,000 crores. So if you look at the chart also, if the FPIs have been sorts of negative on Indian markets, came back when markets corrected, made some investments, but we are seeing in last 6 months, apart from 1 month or so, there has been net outflow. Now, last two slides are on US and China. Before we move ahead and take Q&A, like I mentioned that while US markets are doing phenomenally well, we are concerned about valuation, but earnings continue to justify the valuations, right? What this chart shows is in each of the sectors how much below estimates earnings have come, how much above estimates, which is in highlighted in green, and how much are in line, which is highlighted in yellow. Just look at IT, 94% companies earnings were above estimates, healthcare 93, financials 89, consumer staples almost 90%, industrials almost 83%. S&P as an index, almost 83% companies gave above estimate earnings, and that is what I think is keeping momentum in US markets, because it's not just IT. You are seeing a broader sorts of good momentum in earnings. GDP growth continues to be strong. Inflation, while there are now concerns around inflation, but it's not such a big deal as it was 1.5 years or so back. So I guess even for 2026, and the expectations are for earnings growth of almost 14.5% and revenue growth of almost 7.1%. So I think what will happen is that for next year, the US performance will broaden a bit. It won't be as concentrated or FANG driven as it was in 2025 or in 2024. But my expectations are that in 2026 we'll see a broader contribution. But I expect US markets to do well unless something changes drastically. On the China side, things are more interesting for us, right? What we saw is a lot of China was able is sorts of studying around its target growth of 5%, right? A lot of that was aided by the fact that exports were front loaded because people were expecting US China trade issues. So exporters front loaded the exports, right? And a lot of exports were routed through third countries to their final destination. Uh, one of the so while domestic economy continues to have sorts of subdued phase. The demand side recovery remains uneven. households are still prioritizing saving over consumption. We are still seeing deflation pressure in China. The real estate market continues to struggle in China. Having said that, uh, uh, the fact that exports uh, have been able to support Chinese economy, and the fact that China's focus on innovation and some very key emerging industries like rare earth metals, AI, etc., continues to keep investors excited about China, right? And valuation gap was something which made foreign investors lap up to China, invest in China and Chinese market doing so well, right? I have still have sorts of positive view in China now. I think that valuation gap remains, right? When you're comparing with it with other economies, including India. So, from valuation point of view, also China looks attractive. I think that probably hard phase is over. Eventually domestic consumption will start to normalize, and I see that again in China a more broader recovery will happen, and have positive expectations from China from market returns point of view. For any more details, commentaries, we have recently released note on US and China, where we have dwelled upon past year performances, economy, markets, and we have given very detailed view on what we expect from both the economies. Do read that; it's a very detailed note. If you need any further clarifications or have any further queries, please do reach out uh, to us. Now that's it from me. But before I close, these are the set of products which we have right now on the passive side. So I'll just again pick couple of interesting products which you can focus on from domestic broad-based offering. I think multi-cap ETF, which is Nifty 500 multi-cap 50 25 25 ETF, is something which I'll suggest from the broad market category, if you're looking at ETFs. But if you want to invest in, let's say, index fund, large mid cap 250, which has 50/50 large and mid cap exposure, is something which I'll suggest. From thematic side, new age consumption is a diversified approach to taking exposure in consumer discretionary. It has exposure to autos, it has exposure to e-commerce, tours and travels, reality, fintechs, capital markets, including AMCs, etc. There's a very broad play at consumer discretionary, on which we are bullish from a medium to long term point of view. In commodities, I'll suggest that rather than gold and silver, look at our gold and silver FOF, where we manage the allocation by ourselves. The baseline allocation is somewhere around 50/50, but we do dynamic allocation whenever we feel like that we need to go uh, 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 bullish on a certain commodity more than the other. From Smart Beta, again, we have recently launched multi-factor passive FOF, where we allocate between factors. I think currently, since there is no strong trend, uh, alpha will sort of struggle, or momentum will sort of struggle to perform. So I'll say that if you want to invest right now, a diversified multi-factor approach is a better way to go about it. Other than that, I think dividend leaders 50 ETF, which NFO just finished. I think if you're looking at a value centric play with something which focuses on dividend, that is again an interesting portfolio. You can look at from sectoral side. We continue to remain uh, okay with financial services allocation, and now on energy also. So those are two products which I like to highlight from the sectoral offerings. So that's it from me. I see there are several questions, so I'll take them one by one. If you have any questions, please please do post in the comment box. We'll be happy to answer. So this question by Sunil Wagh was asking any plans to introduce new products in next 3 to 6 months. We come out with a lot of products on a regular basis. So Sunil, basically next year early, we are going to complete our sectoral offering. So we'll be coming out a very different defense product, which we have got constructed from BSC. It is a more diversified defense product. For example, consists of Bharat Forge, L&T also, which are into defense. So it's a more broader, diversified defense. We have infra as well as healthcare also, which we will come out with. But more than that, we have more interesting solution products which we are planning for next year. So do keep tracking products which with Mirai Asset is coming out with. Lok Prakash is asking, is it possible to get this data sheet index performance? Uh, you please reach out to us through social media channel or through RM. I'll check with my compliance if I can share it, and if I can, will share it over the mail. Target for gold and silver over 1 year. This is by Sanjeevni Vanjari. Uh, 1 week back, we gave a target of gold that we possibly look at gold around 4,500, $4,600, right? And for silver we set around 65. Silver is already at 64, but I think typically uh, see 1 year around 5 to 10% more. Silver, we'll have to obviously $65 some around was the rate we were looking at, and for gold we were looking at around 4,500. So but having said that, once these commodities are in a run in which they can continue to create new highs, but like I said, that be a bit cautious on how you're allocating. Don't I think don't over allocate now. uh, Go for targeted allocation, and play basically a bit more cautious now that silver has this significant run up. Yeah, so Lok Prakash is asking, do you have AI and tech index? Yes, we have fund of fund on Global X Artificial Intelligence and Technology ETF. We launched this way back, I think almost 3 years now, 2 to 3 years now. Uh, Done quite well. If you want to check out the portfolio detail, you can either look at on our fund page, or you can visit our sister concern, Global X US website, and you'll get the details of the underlying and the ETF, etc. So someone is asking, who has not written his name. Mafang is at a premium compared to the US market. Yes, yes. Like I mentioned, that sadly we cannot create new units in FANG, and that is why, because of supply demand deficit, it is trading at a premium of around 20% in the Indian markets. There's uh, there's one question by Gaurav, which is on SIF and direct mutual funds. I'm sorry, I won't be taking that. This webinar is for passive, so let's stick to passive funds. But again, do reach out through social media channels, and we happily answer the question. Again, there's a question from Sunil Wagh, who is on Gift City route being allowed to invest internationally, but not being allowed through international MFs. Again, that's a question for SEBI. Won't be able to comment on that. There's one question by Vegi Ramesh who is asking, could you please talk about the use of equal weight ETFs in multi-factor FOF? Is it better to focus on momentum, quality, value, low volatility factor? Please let us know. That's a great question, actually, Vegi. Uh, See, ultimately, whenever we are uh, uh, merging factors, what's the intent? Intent is to reduce the cyclicality. That's the only intent, right? Because if you say that, Siddharth, I want to invest for 10 years and I will never worry about drawdowns, risk, etc., I'll say that go ahead and invest in momentum. Uh, uh, and probably you will get phases when momentum is the best performing fund, and then probably you can book your profits then. But that is not the case. So we create multi factors because want to avoid cyclicality. So let's look at this year. The best performing sector was BFSI sector. It is grossly underrepresented in quality. Quality only has 2% representation in BFSI. So if I was bullish in quality at the start of the year and I was concerned about the market volatility and I wanted to sort of reduce my risk from alpha momentum, why will I invest in quality when quality does not have any exposure to BFSI? Same with low vol. There was negative view on consumption, right? Because urban and rural consumption was weak. So why will I defend the portfolio using low vol? So that is when we started using in our multi-factor top 15 equal weight ETF and Nifty 50 equal weight ETF. Both are large and one is mega cap equal weight portfolio to place this defensive bet, right? So in theory, MQLV should always be able to take care of cyclicality, but in practicality it is not always the case, and that is why we use equal weight when we are sorts of we want to be more sure about about the allocations, and we have done it in our multi-factor through top 15 equal weight when because we wanted to so do a defensive play through that when we are not getting a good signals from low volatility as well as quality. So there are a couple of questions on gold price. I've already answered that. An uncertainty, which international market should we invest in? I uh, I personally like for investments China right now. I continued. I preferred China 1 year back, even now. But China is risky. So whenever you are investing in China, be mentally ready for risk and drawdown. So always invest from your satellite portfolio and be ready for drawdown. If you can take significant drawdown, then only invest in China because China has one of the you have CPC, which is China. You have China Communist Party, which can take decisions which completely and significantly impacts your portfolio. So always be ready for that thing to come out. But having said that, I think China, from a valuation point of view and from other factors, looks attractive. And then again, like I mentioned, that US markets, even at these valuations, I am comfortable from a long term point of view. But yeah, China is preferred. Lok Prakash asking, can you please share those details about US and China market as you mentioned just now? So we have ETF website as well as Mirasset website. Let me check if it is not uploaded there. I will get it uploaded on Monday. So maybe Monday you can look at them if it is not uploaded already. There's one question on international FOFs. No, they are closed for subscription. Anand Kothari is asking if dividend leaders 50 ETF will also declare dividends. Uh, so it may, uh, subject to the condition that we are able to create dividend reserve based on regulatory norms. If that is the case, then it may declare dividends. Nasser Kardus is asking if we invest for FOF, what is the taxation work on this fund for shorter long term? I'm assuming you're talking about domestic equity FOF. In that case, it is just like equity. Uh, Whatever equity taxation is there, equity mutual fund, that is same for the domestic equity FOF. If you need more detail on the Google, just type Mirai Asset Tax Reckoner and you'll get the PDF on which we have mentioned each fund wise, category wise, how taxation will be there. So there are a couple of questions on SIF. Uh, I won't be taking that because again, like I mentioned, it's a webinar concerned with passive. Nitin Pradhan is asking, invested in NFO of new age consumption ETF in December 2024. When will we see real growth of NAV? I think a fair question. I think hopefully next year and next to next year is when I see that most of the uh, uh, government steps pertaining to tax cuts, pertaining to GST revisions will start having an impact on consumption in India, coming and becoming an impact in terms of demand, in terms of corporate earnings, etc. And that is when I expect that to reflect in the funds NAV as well. So I think hold it out for 2 years and you'll see it doing well. So those who have missed out this webinar, getting several questions, please visit our YouTube channel. There, all the live webinars can be viewed again. So Gautam Patel is asking, please consider introducing ETF on Nifty 50 multi-factor MQLV 50. Uh, so we already have a multi-factor fund of fund. Do check it out. It also invests in multiple factors and moves across depending on market conditions. I think that serves the same purpose. Uh, Anyways, SEBI is right now not allowing us to launch a three factor or a four factor product. So I think yeah, like I mentioned, there's one question name is not mentioned. EV India ETF. I think next 1 2 years it should start doing well once, like I mentioned, the steps taken by government on GST cuts and tax cuts starts to percolate down. Small cap, so that's on EV. I think wait it out for 2 years. I think that should be a good product. For small cap 250. Lot depends on earning revival, right? Because if you have to justify valuations of small cap where they are, and I'm talking from broad market point of view, 250 is a broader index. uh, for valuations which it is trading at, for that to get justified, earnings need to come out in a much better manner. So I think uh, we should look at December quarter ending earnings and March ending earnings, and then probably take a call whether small cap will continue to have this muted performance for a bit longer time, or whether earnings surprise us and small cap also starts to do as well as the few other segments of markets are doing. Again, I'm getting a lot of questions on active funds. Again, I'm sorry, I won't be taking those questions. This questions pertaining to passive products. We'll be having webinars on active products as well, where these questions will be uh, uh, can be uh, can be asked and will be answered. So again, a lot of questions on international funds as well. All of them continue to remain closed. And sadly, we cannot open it because of RBI and SEBI restrictions. Uh, there are other peers who may open their international funds if a room is created because of redemption. That is what is being allowed right now. Uh, I think you can look at purchasing from the exchange only when the premium goes down significantly. So my suggestion will be don't buy at higher premium. China market has also recovered. So year or two back, there was some uh, people who were okay with buying at higher premium because their expectation of China recovery was 60-80%. But that story has also played out. So be very cautious or double, triple sure before you buy at such a high premium. Yeah, if you're concerned about the so one question by Anup, if you're concerned about the PE, I think you can look at staggered investments. I think that can be a reasonable approach also. But just consider the fact that for 1 year or so, markets have been stagnant. So while now you don't see optically price correction, but time correction has already been taken place for last 15 months or so. So also consider that fact. So even a lump sum now won't be a bad call uh, for if you're looking for a 5 year or 7 year opportunity. So one person asked this question repeatedly: is there any ETF available at discount as compared to the benchmark? Usually, that is not the case. If it happens, it is usually a mispricing and it goes away uh, as soon as typically it appears. So discount पे होता नहीं है, but theoretically it can happen. Practically it has happened, but that's a rare phenomena, right? Because as soon as something is available at a discount, you can immediately buy it and sell it later, and you can earn some arbitrage. And plus, market makers are there who can quickly buy and come to the AMC for redemption in basket, and that's a free arbitrage which is available, and that is why I typically think things doesn't remain at discount for a longer time. So Sanjeevani is asking, can Hang Seng be a Hang Seng Tech? So please understand that Hang Seng Tech is a tech play. Uh, so it has a lot of these hard tech and soft tech companies, whereas Hang Seng is like Nifty 50. So it's a play on all these sectors. I think uh, while I cannot advise, but if you're looking for Chinese exposure, you can evaluate both the products. Great, I think so. I have answered most of the questions. So thank you so much for joining this webinar. If you have any further questions, I'll be happy to take them. One very important information: we have a Chinese dignitary who or rather, I should have said that a Chinese expert on Chinese economy as well as markets. His specialty lies in China tech and new age themes. He's visiting India next week. He works in our Global X Australia office, and we'll be doing webinar on Chinese market as well as Hang Seng Tech next week on 19th. So if you are interested to know more about Chinese market, where to invest, and what expectations should be there, etc. Please do attend that webinar. That will also be on 19th of December at 4 p.m. So hopefully you all will join me there, and we can have a very good conversation around Chinese market. So thank you for joining this webinar.